If you want to become a profitable trader, I need you to stop what you're doing and I need you to watch this YouTube video. Not just watch it, but pay attention to what I'm going to speak about in this video. Without further ado, folks, let's jump into today's video. This video is going to be purely focused on a lesson that I wish I learned 8 years ago. And that is simply understanding that if you are right on your trade, it's better to be late to the trade and often right instead of always early and often wrong. And something I've spot many traders do in the industry is constantly try and catch tops and bottoms in the market. What then will happen is you're going to be wrong quite a few times and you're going to have a couple stabs at the market before realizing, right, maybe I'm wrong on this trade. And one thing I've noticed a lot of traders do is they will throw money at a trade thinking they're right without even just simply waiting for the trade. A principle I've adopted and I'd suggest you adopt by the end of watching this video is that it's better to be late to the trade and right instead of often early and often wrong. Now for myself, it's so crucial, and I've had 2 instances of that in the month of January. So this is a January trading review. I'm going to run through my 2 most important trades of January, but also how I as a trader could have improved had I focused on being slightly late to the trade. So both trade setups that I took in the month of January, I could have traded a little bit better, but it is something I till this day am improving on every single trade that I take. So let's jump into the charts and go from there. So initially, the first trade was on oil. Now, my bias for the whole month of January, given the current geopolitical escalations that we have, was to buy oil dips. Now, the reality is I knew that trade was going to play through. I knew at the very least oil would trade at $75 a barrel in the month of January. If I knew I'm trading in the right direction, if I knew at the very least oil will trade at those prices, I should have known it's okay to be slightly late. So my initial entry on oil was at 71.52. I'll drop the stamps down below. 71.52. And I was looking for, at the very least, $74 a barrel. In no way, shape, or form did I expect oil to rally there in one straight line. But a lesson extracted from this trade was, all right, I was buying down at the low, right? So I was a little bit early. I hadn't even waited for the trade to mature yet, meaning progress, break structure to the upside, see those buyers coming into the market. So I rode this up. I managed to close half of my position at $73 a barrel, only for that other half to come and stop me out at break even. Now the reality is, if you look at this trade throughout the whole month of January, there were so many opportunities where you could have bought the dip on oil. That could have been a simple Fibonacci extension play, running off the back of a fib retracement, buying dips, right? You could have bought dips on multiple occasions. Now the reality with this is, had I been slightly later to the trade, I would have had more opportunities to buy this dip. However, for myself, I got in early, right? It was one of my first trades of the year. I got in early and then I asked myself, all right, I don't want to risk this money that I've made. I'd rather sit out. I wanted to, at the time, oil was trading above $75, which was my initial target for the month. When I started the trade out, I planned where it is and I planned where it could potentially go with my current analysis. And 75 was the peak that I wouldn't really want to be buying over 75 because this was a previous high. And rule of thumb that I have is that I don't want to be buying anything higher than 75 or a previous high. So that was the rule I made for myself. And the reality is I still have the alert in place here. I told myself if we see $73 a barrel again, I'd like to get involved. 73 being where I previously locked in gains. So I'm very specific with what I'm trying to do. But the reality is the mindset of being slightly late to the trade, meaning had I not taken the position here and I was happy to wait an extra week, I could have jumped on the back of these dips and rode the market slightly higher. So despite me showing this lesson and teaching this lesson to you, it is still a mistake that I made within this month. And it is something that I'm working to improve. And I suggest you take that on board for yourself. And I'd like to summarize that before I show you the next trade, that it's better to be slightly late to the trade and often right on the trade instead of often early and always wrong. Now that mindset of catching the best entries, always trying to catch the tops and bottom of the market, will come around and humble you in due course. That is what the market will do. However, if you build active principles that you can follow, a set, simple approach that you can follow, it's going to be a lot easier for you to repeat in the market, knowing well and truly that it's easier to be late to the market, right? Instead of early and often wrong. The second trade was on dollar yen. Dollar yen, I was buying this trade from around 143, 143.75 actually was the entry. Now, my mindset with this was dollar was being bought throughout the month. I wanted to buy any dollar dip that I could. And I saw dollar yen unwinding what it did over the festive periods. Over the festive period, I'll briefly show you. Over the festive period, we had this large unwind on dollar yen to the downside. Large unwind. Starting the year, I told myself that I wanted to be buying dips on dollar yen. I had the opportunity when we traded into 143.50, and there's a nice little inverse head and shoulders. Yeah, I wanted to jump on the back of that, which I did. But I pulled 50 pips out of a trade that could have at the very least yielded me a 400 pip gain. Now, what's my lesson to this? My lesson was I was slightly early on the trade, right? And I could have been slightly later to the trade and had a bigger move. So same principle, same lesson, same mistake I made in the month of January. And looking at that, you know, I caught a 50 pip move out of it, expecting that dollar was slightly range bound over here at these highs in the lower time frame. The market was struggling to break higher at the time. I thought, all right, you know, looking at the structure, if I just show you like that, looking at the structure there is a very high possibility that we could have rejected from 144 and very quickly be trading back at my entry. Let me pull this money back. Let me pull that 50 pips back. I'll buy the dip if I have the opportunity again to do so. But the reality was, oh, that was quite funny. The reality was I didn't get the opportunity really to do that. Once we did trade back into these levels, I didn't like the trade. Right? I didn't like the trade. I was focused on the oil and the gold buyers because of the escalations in the east. Now, that's a human error. That's my fault. But the reality here is, was I slightly late to the position? Was I buying these dips over here? There would have been an opportunity for me to, at the very least, catch 150, 200 pips to the upside because this rally was phenomenal. Right, we traded at the high of 148.50, where I actually started the month out suggesting we could see the likes of 150 over the next couple of months. But the reality is, as a trader, we can't unwrite the past. We can't undo the past. It's happened. It is what it is. We need to focus on the very next trade. So something I've learned, folks, and that will be the summary of this video, is that you need to ask yourself, if you're in the right trade and the trade's right, can you be slightly late to the position? Is there anything wrong with being slightly late to the position? No, there isn't. Right? No, there isn't. Even, for example, crypto. If you're trying to buy the dip constantly and the market keeps dumping, why not wait a little bit? It's easier to jump on the back of something when it is rallying, when it is going, right? You have less downside. You have less stress instead of just waiting a little bit. So that's the summary of this video. It's to be patient. It's to use this principle. And if you use this principle, I promise you, it is going to improve your trading. Be slightly late to the trade. It's going to assist you in being often right instead of always being early to the market and always wrong. Try and keep that one in mind. But folks, hope you enjoyed this video. If you are new to the channel and you're still watching, much love. Check the description down below. I've left a couple of links which should help you. There is also a link to my free Telegram where I share some of my thoughts, some of my tips, and so forth. But subscribe, drop a comment, give us a thumbs up to know that you enjoyed this video. And like always, my friends, keep going, and I'll see you on the next video. Peace out.